Hello, everyone. So we are going to start this, very interesting and very meaningful session that everybody is looking forward to. Though at present there are 150 people who have logged in, but I am eager to start this, so we cannot wait anymore. Welcome everyone, and welcome to our dear speaker, Mr. Samir Arora. Markets have been going through some tough times, and these are the times which are teaching lessons to various fund managers. And we have seen over last 2.5 3 years, on one side broader markets have been kind of performing and many stocks have delivered great returns, but at the same time many ideologies that many fund managers, many portfolio managers have been talking about, that valuation does not matter, there are businesses which are high moated businesses which consistently compound. All these things have been questioned because over last 6 months, many high valued companies have actually seen, prices falling. And at the same time, many stocks from broader markets have been actually participating. So, we know there have been fund managers, very, very few fund managers like Mr. Samir Arora, who bring with him 3 decades of experience. And I have been interacting with him over the last 2.5 3 years. And every time he has been, reminding us that markets always teach you lessons. You cannot be fixated to one style of investing. You need to be diversified. You need to be nimble. You need to be, adaptable in terms of being aware of what is happening, and you need to be flexible in your approach. And that is exactly what is market teaching us today. And the topic of this session is also kind of, I would say, suggested by Mr. Samir Arora only, which is old markets and new lessons. I myself curiously
the other way around. Old lessons and new markets.
Old lessons and new markets, right? Old lessons and new markets. Yes. So we are in the new type of markets, because it seems that today market is more cognizant and more careful about valuations, which market was kind of not so much careful about in the in 3-4 years before today's time, because maybe economy at that point of time was struggling. We will try to understand from Samir everything about it. Just to give a brief background about Samir Arora, he brings with him 3 decades of experience. Did his engineering from IIT Delhi in 1983. And then he did his MBA in 1985 from IIM Calcutta, and then went to the Wharton School to do masters in finance. And post that he has been doing public money management in equities, and also manages popularly known long short funds. And I will also tell you, the last 1 month has actually been so difficult that I know there are many long short funds which have not delivered negative returns, even they are delivering negative returns. So we will understand all this from Samir Arora in this session, what is happening in the markets and what are those old lessons which we need to remember in these new markets, so that we are able to steer the way forward. Over to you, Samir.
Thank you. Thank you, everybody. I had put up a few slides, which let's see if we can work it together. Otherwise, we can use some other format. One punchline from my slides is going to be not there, because the way I had made the slides was that you will see one line at a time. But now the way this system is working, you will basically see the whole slide together. But anyway, let me just wait for a minute.
Samir, I think you can start. The presentation needs to be reloaded, because I think we re-logged in. So it's getting reloaded. You can start in the meanwhile. Okay. I'll bring it on the screen in next 1 minute.
So, the big picture that I have for you today is, broadly speaking, that there are a few things which have been around forever in terms of lessons that you take from our market. And these lessons are broadly to do with the fact, number one, that you will, as an investor, and I'm looking at it as a fund manager, you will not tie yourself up in knots, saying that, for example, these days I see people saying that we don't look at inflation because, inflation is such a difficult thing. It is done by macro guys. We are micro guys. We look at businesses. We look at what is the value of the business, but we don't look at, say, inflation. Or we don't look at, anyway, started. So let me start from here, because some of the things are a bit good. Okay. So you have the control of this, or I have the control of this? I have? Okay.
You have the control.
Okay. So now here, I had used Google Alert, and you would have normally seen it one line at a time, that the real golden thing before I start is Nemo scit aliquid aliquo. This is a Latin saying for my saying, which is nobody knows anything about anything beyond a point. I have just used Google this thing, but just to say that even though I will give you my stories beyond a point, who knows? This is my best guess of how to interpret things and how to do things. But beyond that, really, we are all in it together with the same kind of information and the same kind of luck that we all need to get some of these views right. Another big picture lesson that I would give from the lessons that we've had in our life is that the most important thing, according to me, to do at any time as an investor is to have things that you will not do. Because what you do in markets, it's much better to remember the rules, which mostly are to do with don't do this and don't do that, rather than to say do this or do that. And as we have said again and again, that in our thinking of the markets, we only try to avoid the bad. The good, when it becomes very good, the money when we have mostly not made in good managements. We have made in managements that were not bad in the beginning, which turned out to be good. In the beginning, when we bought these stocks, we didn't know that these were good managements. All we knew is that these companies had many good things going for them, and the management was also adequate, but we didn't know that Rajiv Jain would turn out to be a star, or the HDFC gang will turn out to be stars, or anybody else. It all happened because they were at the beginning normal guys who turned out to be good. And in some sense, the philosophy, which I'll show you in the end, has to incorporate all these things. So now let me do the actual big picture lesson 7 or 8, which are valid for all times. And then with those points, I will try and tell you our philosophy and how it takes care that none of these mistakes we make in some sense. So the first thing I see nowadays is that, the fund managers come on TV or otherwise and say, we don't do this, we don't do that, we buy only these stocks, we look at long term. And all these things put extra pressure and reduction of flexibility of a fund manager. If I was to come on TV every day and say, I like this stock and this stock and this stock, it is highly likely in any bad time that there is something that goes wrong with that stock. But because you have come again and again trying to defend a particular stock or a particular style, that you are stuck with it. I attended once like a course actually organized by Credit Leone called CLSA University. It actually is just a 2-3 hour course that I did or attended. And there these guys were saying, this was maybe 20 years ago, that if you are trading in a room, which is, the room is being shared by various traders, you will not even stand up and say yes for a trade that works in your favor. Say gold goes up, because now everybody knows that you are aligned with gold, and therefore if gold prices fall, you will not be able to immediately get out of that position because you have tied yourself up in that position. In terms of social, this thing, in terms of what your peer group things that you are doing and all that. Another one which I see these days is that till last year even I would say that we don't look at inflation because we don't know what is the US inflation. We are not macro guys, and it's very difficult for us to have a grasp of what is happening in the US market. They have to do it themselves. But when you are in the middle of an episode, when you are in the middle of something where a Federal Reserve is saying that inflation is very high and I have to bring it down, or the Indian Reserve Bank governor comes into a surprise sort of cut, or sort of a surprise hike in interest rates to control or to moderate inflation, you can't say I don't look at inflation. It's like saying that normally when we look at historical data, we may say wars don't matter, because if you had invested before World War II, you would have made money if you held it long term. If you look at 100-year chart, wars are maybe some dots, even though this might have been World War One and World War II or some Iraq war or this war. But when the war is going on, you can't say, I don't look at wars. So this is what I mean. The point in our thing is that you have to be sensitive to everything. And the worst thing that you can say to yourself is, I don't look at the market. I mean, unbelievable for anybody to say it. But look at it differently. We all attribute everything to what Warren Buffett said in his life. And Warren Buffett said, I don't look at the economy. Now, the difference between him and us is that he has 100 or God knows 90 unlisted companies in his portfolio. He would, I guess, on a monthly basis, as he says, get information on how the railroads are moving, how the sales of jewelry is happening, how brokerage, because he owns a brokerage, how real estate is moving, because he owns ice cream, he knows how many people are eating ice cream and how many people are eating candy. Why does he need to look at the economy? He knows how furniture is selling. He knows everything because for him, his 100 companies are a very good representation of the economy. So he comes around and smugly says that I don't look at the economy and it's a waste of time. But he has information on 100 companies across different sectors and he doesn't have to look. Peter Lynch says, I don't look at the economy, but he works in Fidelity. And there must be 50 guys in their economic team which is looking at the economy, and he looks and gets one number out of them and he has looked at the economy. So all these things we have to get over and realize that the market has so many things going for it that just these easy things are not the solution. And if you guys are investing on your own account, it is not just straightforward to say I buy this stock and that stock. The other thing which I have always used is that you will not use hindsight analysis to project what may lie in the future. And here are some things, again, these should have come point by point, but doesn't matter. So, these days and for the past many years, we have been told that if you buy good companies which are performing well and you hold them for the long term, see how much money you can make. And say an exhibit A is Kotak Bank or a Bajaj Finance or whatever, that see in the last 25 years, you would have made 450 times in Kotak Bank if you had, and this is a proof of the argument that you buy good companies and hold them for the long term. Except that none of these CNBC and other guys go and ask the fund manager, but how would you have known 25 years ago that this was a good company to buy? And how would you have imagined that these companies will do better than other companies? For that, there is no answer, and your philosophy should incorporate that into account rather than saying that you buy good companies and hold them for the long term. The reality is that if you look at the companies that have done well for the last 20 years, and I would have owned many of them during this period, whether HDFC Bank or Kotak Bank or Bajaj Finance, or their various times Eicher Motor or Page or whatever. The reality is at that time you did not know that these are some of the best things ever that we have found. They were good companies, they were doing well, and we were looking at them on a year-to-year basis, and they continued to do well and all that. But if you today go back and look at companies which have done well for the last 20 years, there is no need to analyze them further and say, see how well they did in 2008, see how they came out of a demon, see how they increased this, how they increased that, because you have started with the line that you have chosen today the best companies of the last 20 years. It's like today choosing to study the life of Mukesh Ambani or Steve Jobs and say, see, Mukesh Ambani had this problem, but still he came out of it. Or, he had a fight, or Steve Jobs had a divorce and he came out, because you already know that in the end they were successful. So everything that they have done has ultimately landed them here. And therefore, anything that you analyze from there will have no meaning to predict who's another Mukesh Ambani or who's another Steve Jobs and all that. So, and this Daniel Kahneman, who's a Nobel Prize winner and one of the first Nobel Prize winner in economics, who's not an economics student, he's a psychology guy. He said that the illusion of validity is found whenever predictive judgments are made. You can analyze the past, but you cannot analyze that past to make predictions. I'll show you some examples of that. So this is a good example of how backtesting works in our life. And here I'm using the analysis done by Mohnish Pabrai, who, as you know, is a big Warren Buffett fan. So he came up with this idea, and at that time only I tweeted about it, that this is absolutely a ridiculous test. But just let me show you so that you understand how looking at the past does not work. So he came up with this study that why do we have to do any work? Why don't we just clone successful fund managers? Very similar to saying buy successful companies. It's just that I'm not talking about companies here, but talking about this study, because this is an actual proof of what can go wrong when you do these things. So he said, okay, I know these successful fund managers, and every year if I look at their top 5 ideas, and from these 8 guys that he had chosen, plus himself he had chosen, and I will look at the stocks that they bought, and when the news comes out, which is maybe 10 days after the quarter or whatever, after the year, I will buy those stocks. So this is called the shameless cloning portfolio. And then he said also that if the stock that comes up from the past data comes out to be a utility or a REIT, I will ignore it and buy the next stock and see what great performance I got, which I'll show you on the next slide. But this was such a wrong way of analyzing performance or trying to create this portfolio, because you already knew that these guys were successful. You already knew that if they've been successful for the last 18, 20 years, mostly the stocks that you will end up copying historically will turn out to be good stocks. Otherwise, they would not have been successful. You already knew in your mind, for whatever reason, that utilities and REITs didn't work. And therefore, you said, if a utility comes or a REIT comes, I will not buy, and see what a great back-tested model it is, and quickly see what happened. So he did this study for 18 years, and he found that the S&P during this period was up 5.4%, whereas his portfolio was up 17.1% per annum, which is outstanding, except that this was all in the period in which he was doing the study of successful companies, like you would do for successful companies, he was doing for successful fund managers, and he said, see what a great model. And then he tried it for 6 months, and for this 6 months, he said, performance is still very good, and therefore, see, he said, this is not my quotes, his quotes, that we should not fixate on short-term performance, but the 2000 performance provides further evidence that my model is working. And then the model went live. Now all the tests have been done, the back testing is done, your PMS has started, and now you have bought stocks based on this basis. And let's see what happens. Now this fun is lost because every line should have come separately, but you can see here what happened in 2018. Portfolio was down 17%, S&P was down 2.9. He used language very similar to what we see. When this model had done well for 6 months in 2017, when he was trying it before releasing it, he said, "Oh, it's although it is a short period, but it further reaffirms." But when it went down from 7, the market was down 2.9, was down 17. He says, "Keep the faith and do not overreact." Then came 2019. The portfolio was up 21, S&P was up 31. So now they said it's only 2 years old, so don't draw meaningful conclusions. Then came 2020. The portfolio was up 3%, S&P was up 16%, so there was nothing said. Then came 2021, where the portfolio was up 25% and S&P was up 20%, 28%. And when you are underperforming by 3%, you say portfolio has managed to keep up with S&P 500. It has not. 300 basis points is a massive difference. And overall, we say we are just getting warmed up. It's the same thing. If you look at the history and you try to get the future, you have to say, look at it for a decade, for 2 decades, for longer, and you'll make money. But year after year, for 5 years out of 5, the fund has underperformed. You cannot look at history to decide the future. Simply, in simple terms, if history was a good indicator, then good stocks would never change. You looked at the last 20 years history, you found the best stocks. If these stocks are supposed to do well, then 20 years later, you will look at history, these stocks would have done well. And since you look at history, those stocks should continue to do well. And broadly, the good stocks will never change. And you know in reality that it's never the case. The reality is that many of these stocks that I had the pleasure of owning, and I still own some of them, when they started 10, 20 years ago, the markets had lower penetration overall penetration of that whatever service or product they are making. The valuations were lower. You were starting from a lower base, and you broadly did well over the last 10, 15 years, and therefore you outperformed the expectations and you did well. How does any of this be taken for granted today, that you are trading at lower valuations, that your expectations are low, that the competition is less, that your base is less? So these things will not work. And again, as I said, you have to bring these things into our philosophy, which I will come to quickly. The other one is very easy, that you will not overpay for anything. This is so easy that it looks funny that in a seminar with whatever 200-300 people, that you are right now having to explain such simple things, that when you are investing, you are basically saying, here is my money, and in return, you are giving me the payoff or the whatever results of the thing that I am buying. So we are exchanging two things. How can it be in a financial setup that I say that here, take my money, but what you give me, I don't care what price you charge for it. If you look at it in an auction where billionaires are bidding against each other for things that have no real financial this thing, except it's a pink diamond, it's a copy of a book, it's the first edition of the Constitution, things like that. Even there, these bidding stop. In theory, the guy who's bid 20 million, but he has 25 billion, why should he stop? So even things bought for love, for ego, for putting in a museum, the prices stop. But here, where nobody has any other interest except to exchange one stream of income which you may get from your cash either being put somewhere else or being put in a bank and earning interest, and you are exchanging with the other guys this thing. How can it be that people can say that prices don't matter? But let's go further into this. Again, these should have come one at a time, but how much more proof do you need than this? Aswath Damodaran, the great value professor at Columbia, says great growth companies can be bad investments at the wrong price. Lou Simpson, who was previously working for Buffett, said even the world's greatest business is not a good business if the price is too high. Seth Klarman, whose book sells in aftermarket because it's not printed, I think for $3,000 to $4,000 you have to pay for the book. Says that many investors are tempted to become more optimistic when a security is performing well. And of course, Mr. Buffett, which I had tweeted already, saying for an investor, too high a price for the purchase of an excellent company. All these things are known and known forever. It is not actually that today these things have come up. I'm just putting them together for you. Another thing quickly, because I'm also trying to say what we do slightly differently. Nothing can be totally different, but I'll explain quickly in the end. But the thing is that if in an investment, the justification for buying a company is that you need to be able to say today that it has the best management or that I can project for 20 years the growth of this company, you have already lost. The company should be a good investment without you being asked to make such aggressive, impossible decisions that I can see this for 20 years and therefore it is justified, because if I'd seen it for 5 years or 6 years or 3 years, it could not have been justified. We are too straightforward. We say 1 to 3 years at a time. We are not here looking for an investment which we think 5 years later is very good, because we have no idea. And if it is so good 5 years later, but not good 3 years later, that means it is too expensive right now or too this thing. And therefore you have to stretch the goal. Now, somebody who does private equity or even more venture capital, he may do that, but he also doesn't know. He's just playing a different game. He's buying 20 companies like that and hoping that one of them will strike it and all. We are in the public market not doing like that. We have to be able to see in a shorter period, but let me give you some examples. So people think that, if you do things by analyzing the past, this is a good example. So this book called Built to Last, which is a very famous book, I have it in my office library. So these guys studied, which is written here, of course, these should have come separately, would have been more fun. But they took a sample of companies that had effectively outperformed the market by 15 times. Now, I don't know exactly how they calculated it, but it's in the book, from 1926 through 1990. So there's supposedly the good companies of the previous 50, 60 years. And then they studied them to say what is common in these companies. So they came up with these very impressive things, which if somebody came with these today, Collins could have started a PMS in India. So he said there is no tyranny of the or. That means they will do both the things. It's more than profits. There is some bigger purpose. They have big, hairy, audacious goals that the company has. They try everything and then they keep the stuff that works. How can you ever object to this? And they have good enough, never is. That means, they will try to do better than being good. They have a very good succession plan because they have homegrown management, which means, you have prepared your second line and third line, all the things which you would say, wow, if this is what people are doing, there can be no better research. And then you see the companies that they found in the book. The companies, this was in the 90s, they found 3M and American Express and Boeing and Citi and Ford. And even you would know, even if you don't invest in the US, that nobody really thinks today that Citi and Ford and GE and HP and IBM and Motorola and Nordstrom are the best companies that you of this thing 20 years later. And it's not even that today they are not there. 15 years ago or 10 years ago or around 2008, the Citi and Ford and GE and HP were all gone. And then this author had the audacity to say that the book never, later on when people criticized him, that the book never promised that these companies would always be great, just that they were once great. Now look at this other book. It's called Good to Great. And these guys then studied, so Stanford professor and all, they studied 6,000 articles, generated 2,000 pages of interviews. Now, today when a fund manager, or forget about fund manager, when you as an individual analyst, if you're only reading material is that what came in Economic Times and Business Standard, if you're very hardworking, you maybe even read a magazine called Business Today or Business India, are supposed to find good management. Here, look at it. These fellows did like whatever, X amount of work. And then they found companies. And what are the companies they had started with to find common factors? They had looked at, it says here, that companies that had done well for 15 years, second line, they sustained their performance for 15 years. And then they said, let's see what is common in these companies. And they found that this first who, then what, which basically, I guess, means that, first you'll find the guy and then you'll see what he can do. And then you'll confront the facts and you would hide it under the carpet. And then you have a flywheel, which, even now we used to say, oh, his website is great, so he'll get more business. He gets more business, so his cost will come down. His cost will come down, he'll create more sales, blah, blah, blah. All the things that you would think. And technology accelerator, he bought a computer and then he put people on the field and then he had iPads, whatever in those days. It's not now, this is 2000. And then look at the companies they found. All those companies are doing miserably, not just in the stock market, but in real life also. So again, Daniel Kahneman, one of the best books ever, please read it, in Thinking Fast and Slow Sets, particularly about these books. So the basic message of Built to Last and other books is that you cannot take the best companies and say that these best companies had, for example, great CFO. Because you will also have to look at other companies which had great CFOs, but which didn't do well. You cannot say that these companies did well because the family, let us say, was not in management and they allowed private guys to come in. You must also look at all the companies where there was private management and no family, and how did they do? You cannot choose the 5-10 companies and create a story. That is the whole point. And if you don't get that, some of your returns will be limited. So I interpret it my way. That let us say we look at these 10 companies and find that Ford, Henry Ford, and Bill Gates, and Zuckerberg, and Amancio Ortega of Zara, or Larry Ellison, or Sheldon Adelson of the Las Vegas Sands, all of them are school dropouts. So you cannot come today and say, therefore, this promoter is a school dropout, so he's good. Because you must look at all the guys who dropped out of school and see what they did and how that thing was. Then you can say that, yes, this is a strategy. You cannot look at the successful guys and say that I am, this is a formula. That's the whole point. The other thing is about evaluating long-term growth. Please understand that very few companies grow for very long periods at 20%. So if you are thinking, it's like saying that if somebody comes to you from a, say, who wants to open a restaurant, and without knowing anything, you say, should I open a restaurant? The answer is that you have to say no, because around 70% of the restaurants close within 3 years. So this is called base probability, that if you don't know anything else, you broadly will say no because it is very difficult. It's the same thing with these companies. Very, very, very few companies grow at 20% per annum. But you don't need 20% per annum to do well. And here are some examples for the last 10 years. Look at the stock price growth and the revenue price growth. Now, of course, somebody will come and say, hello, why are you looking at revenue? You should look at profit. You should look at cash flow. All those things are true. But when you're looking 10 years out and 20 years out, the first thing that you'll have to grasp it, whether the revenue can grow at this rate or not, because you cannot say that in the 15th year, when his revenue grows 20%, for some reason his cash flow will go 25%. You may say that for the next few years or the past few years, saying that, he shortened his working capital cycle, he did this activity, that activity, and therefore he did well in terms. Why does it say no sound? You guys can hear me or no?
Yes, Samir, we can hear you. No problem.
Okay, good. Because I said so one guy on the side. Okay, so the point is that very few companies do well for so long, and here is an example. But of course, somebody will say, don't look at revenue, look at profits growth, or the new story these days, look at cash flow growth. And therefore, my lesson number 7 and the last 7 is that thou shalt not be confused, because the whole attempt will be to confuse you. So let me explain. Obviously, we should look at cash flows. But what a misrepresentation to the innocent public to say, look at cash flow. Because before that, everybody knows that Tata Steel has a price earning multiple in general times of 5 or 6, right? Or SAIL has a multiple of 2. And say a consumer company has a multiple of 30 or 40 or whatever. And the tech companies have a multiple of 25. This is on earnings. Why is it that the consumer company has 35 multiple and the steel company has 5 multiple? Because you have already built it that this earning is cyclical, this earning is capital intensive, this earning you can't predict, whereas the other earning will convert into cash, the other earning will be smooth, it will be secular. It's already known. You cannot give the same answer 100 times. It is already known that the consumer companies have better ability to convert cash to earnings to cash, etc., etc. That is why you started them with a 25 multiple. And nobody's objecting today to say that that company should not get 30, 35 multiple, whereas the other fellow is getting 3 and 4. The question is that 35 multiple has enough for all these things. Now, don't tell us that because he actually did the things for which he started his life with 35 multiple, that now they should get 100 multiples. That's the whole point. There is already acceptance by the market and everybody, including Warren Buffett and Lou Simpson and Aswath Damodaran and even me and whoever the last guy I quoted, that a steel company will get 2 price to earning because it is somehow already built in. So now go well beyond that to say that this fellow converts to cash and the other guy does it. That is already there even in the old PE. The other thing is that while projecting into the future, unless you're a very bad company today, where everybody can see that your working capital is long, whether you basically you don't have cash management system of HDFC Bank and you give too much credit. Broadly speaking, for the companies that we are talking, which are good companies, broadly the earnings and cash flows have to be plus minus the same, because cash flow is basically converting earnings into cash. It is not coming out of thin air. And so unless you say that today the company is either loss making, it's one of these new tech companies where you may say that once they cross some break even, they will get operating leverage, they will get this leverage, and therefore their fixed costs will be shared over a bigger base, blah, blah, blah. Therefore, their profits for the next 10 years will be higher than their revenue growth, and maybe their cash flow will be higher because they would do this and that. For a company that is well run, which already has low working capital, which already outsources things, which already is very efficient, on what basis can you say that going forward, the earnings are going to be lower, but the cash flow will be higher? And the humble PE has not survived this long for nothing. So first thing is that, as I said, it is already inbuilt that the PE of a real estate company or a commodity company will be lower than say a staple company or whatever. Second thing is, in the end, in the very long term, while projecting the future, as I said, unless you are very specifically able to say what new things he will do to get cash flow higher than earnings, effectively the maximum that a company can do is to convert the earnings into cash. And that is a sign of efficiency. But if you're already an efficient company, so in this model, actually you should buy in, which I believe also, that you should buy inefficient companies. Because if, of course, provided that he's giving a plan as to how he'll become efficient, that, I am giving iPad to the sales guys so they will quickly bill. I will do some discounting for getting cash in, or I have, instead of creating my own capacity, I've outsourced, so I will save here or there. But if you have done all those things, what the hell? What will you do? You are going to be driven by what happens to your revenue line and what happens to your EPS. And that is all the extreme that you will get. So that is the point here, that you can't get it out of thin air, because all these things, if you are good, has already been done. And this is the last one, actually. This was actually, again, should have come in. I should let you see this. That please remember the halo effect. I've already recommended this book only 100 times. And it is one of the best books ever, saying that everything that you do depends on the stock price. So this should have come in 2 boxes, would have been more fun. But anyway, you can read it, that in May 2000, the price of Cisco was $80. It was ranked at that time as the world's, according to Fortune magazine, the most admired or second most admired. And this is what the magazine said about Cisco. Cisco must be considered one of America's truly outstanding companies. No networker and laser focus. They all flew coach, the most customer-focused human being you'll ever meet. And then came May 2001. The price of Cisco fell to $15. Now, actually, Fortune should have said it is one of the most admired companies, and unfortunately, because of market reasons, the market has price has fallen to $15. But what does it say? What will the market say? Because this is like a representation of the market. That Cisco has exhibited a cavalier attitude towards potential customers. Their sales techniques are irksome. 1 year ago, they said it's the most customer-focused human being, and it has alienated customers. And then it said acquisitions, forecasting, technology, and senior management all have failed Cisco in the past year. This is what is going to happen when these stock prices fall. Instead of calling them the most admired, you will call them the least admired. Here is an example again. Should I come one by one? But you can see that the top guys cannot last, don't last. And maybe once in a while, 1 or 2 will last, or 5 will last. But you don't know which one. So you might as well assume that none of them will last, particularly if their valuations are very high. And this, of course, for 1999 Fortune magazine, talking about GE. As you know, GE had this great succession planning. They had these 3 guys, and these 3 guys were in the running for many years. And then they took Jeff Immelt. And you know what happened to Jeff Immelt? That a book came out, which I also tweeted about maybe 6-8 months ago, called Lights Out. Basically, GE went near bankruptcy. But look at what they thought about GE in 1999. It's a true meritocracy. You have to prove yourself every day. All the things which today, if we talked about any of these companies, you would be absolutely delighted to own their shares and say, I can have a 10-year view. And this, of course, is my old one, which I'll explain in our own thing quickly. Then we can have questions. Let me quickly do. So how do we, because we have to incorporate all these things if we believe in this. Doesn't mean that every one of my 35 companies, even one of them will not have, say, a high valuation. But we will, I'll explain. Okay, so big picture again, these should have come one at a time. Everybody's mantra is buy good companies and hold them for the long term. And this line is one of the biggest bullshit lines that fund managers have been telling the world, and the world has been accepting and applauding, because every word of this, other than maybe buy and is complicated. So what is a good company? What is long term? What about a company that is not good, but nearly good? So for example, if somebody comes and says, I only buy companies which have a 15% ROE. Has anybody ever thought that what will happen if the ROE of a company is 14.8%? Second is, we hold them for the long term. Suppose the company gives returns in the short term, then what will you do? Let us say the stock doubles or goes very much out of line with the market. No, I hold them for the long term because that is the mantra that was told by a fellow who doesn't himself do it, like Warren Buffett. So the question is, each of these you have to have a philosophy or at least some framework. It's not some great philosophy, but you must have an operating this thing as to how to do. So what to buy or how to define good, how long term is long term, and how to know today that the company will do in the long term. What to do if the company becomes very expensive because it gave the returns. And thing is, owning companies that are clearly accepted as good, okay, we know some of them, but what about slightly different? So let me explain in 2 minutes. So first I have to explain my old formula. The problem with this formula is, if I tell it to you, it is so simple that from tomorrow you won't attend, forget about anybody else's webinar, you won't attend my webinar also. So first understand the markets. That literally half the companies do better than the index every year. This is to do with arithmetic. So if there are 500 companies in the S&P 500, it can never, ever be the case that 20 companies do better than the index and 480 out of those 500 do worse than the index, because an index is an average return of those 500 companies. And even though it's not a pure average and it is weighted by market cap, it's still an average only. So if you don't believe, look at the second last column where, so the last column is telling you what was the S&P 500. I have taken from 2005, basically because our Helios started in 2005. This formula will not change. If you go back to any year, you go to Indian market, they'll show you Moroccan market. It has to do with arithmetic and not the market. But you can see in the second last column that broadly speaking, some 230, 20, 40 companies beat the market and 280 get beaten. So in a big picture sense, let's say half and half. And you can see the average is 234. And in a very narrow year, in a very bad year like 2020, not bad in that sense, but bad for the breadth, 168 companies only did better than the market, because once in a while, some very large companies will do very well. Like in that year, maybe Amazon and Microsoft and all these must have done well or did well. And therefore, the index went up, but the average stocks didn't go up. But still, there were 168 companies. And this is arithmetic, so it won't materially change whether you calculated this average over 5 years or 10 years, because every stock you will take over 5 years, the average will be over 5 years, the index will be over 5 years. Broadly speaking, little less than half will do better than the market. And how many times have we been told that 20 companies do well? Anyway, now look at it for India, and then I'll tell you the formula. So in India, we didn't want to look at even 500 companies because that would be too many companies. And the 400th company, who cares how it is doing? So we just took the top 300 companies each year by market cap and see how many of those beat the 500 index. It doesn't, because we don't have a 300 index, doesn't matter. It's all the same thing, broadly speaking. So here you see that again, slightly less than half did better than the index. So that means the top box, the last company of the top box, which is not half, but same half. You can make it 40% and 60 or 45 and 65. The last company of the top box is beating the index. And the best company of the second side is being beaten by the index. Understood? Kamal, you can understand it? If you can understand it, all these guys can understand it.
Absolutely, right.
So that means, what is the work? We may dramatize it, we may make it bigger. Your only thing that you have to do is to say, is this stock part, because you don't know next year where it will be. But broadly, you know that you have to basically divide it into two piles. Mota mati, they are half, although it's a little less, it doesn't matter in these qualitative things. But you have to basically say, does it have higher chance of being this box or in this box? For the next 1 year, 2 year, whatever period you can analyze. Now, what are the factors that make a stock do worse than the market ex ante? Ex ante means before the event. We don't, later on, it could be that the worst company does the best or the best company does badly. But if you don't know anything and you're trying to say what will happen next year, you have to say ex ante, what are the factors that broadly make a stock do badly. And what are those factors? According to us, there are only these 8 factors. If it is from a bad theme, it has from a bad industry, you might say, oh, this stock did badly because it's from the infra sector, or this stock did badly because this theme, some PSU, it is the fifth largest Indian bank, who cares? Or it might be some ninth steel company, or you might say it is a very competitive industry, or you might say everybody knows this guy is a chore, or you might say it has very high valuation. So how did we ever think? The point is, all the reasons that you will give after the event to say why your stock did badly, unless it is something that I bought it and then something happened truly surprising in the company that they did badly, broadly, these will be the reasons. So all we say is, don't buy stocks where these things are bad. Now, what does it mean that if a company is very good, so it is good on management, but it has very high valuation? So previously we used to think of trade-off. It's a good company, but it is high PE. Now we say, screw it. Single factor is enough. If it is a good company with high valuation, the high valuation say we will reject it. If it is a bad company and cheap, we will reject it for being a bad company. Why? Because we have understood that some 200 companies are going to do well at the end of it, or say 150, whatever, depending on your universe. If my enthusiasm, I reject 5 companies because they were too expensive or too bad, and they do well, so फिर क्या हो गया फिर? Still, I have 145 companies in which I could have squeezed myself in. Now, today we think that one of the worst managements in our country, which is this commodity fellow who was trying to do open offer till 2 years ago. Everybody knows that every time he's whatever he is, but the stock was up 2-3 times in the last 2 years. So क्या हो गया फिर? मतलब क्या हो क्या गया? If we missed it, doesn't matter, because ex ante means prior to the event. Mostly these things don't work. Once in a while, a very high PE stock will also work. So क्या करे फिर? But the odds are not in your favor, and that's what I meant by the casino. So when you go to the casino, you and the gambler, you are the gambler. So the gambler and the casino are actually being on opposite sides of the same bet, except that the casino has a small advantage over you because of things which I can explain. What is the advantage in a roulette or in blackjack? Okay, that is a separate topic, or I can do it in the question answer. So if there is a small advantage for the casino, let's say 2, 3, 4%. Now the gambler, if he plays 2 times, 3 times, 4 times, the gambler can win. That's why you go to the casino. But you play 500 times, you play 1,000 times, you cannot win. And even if you win, then some other fellow will not win, because that fellow is playing with millions of people, you can say, on millions of games with the same people. And then the stats will work. So let us say that statistically, we say that we have a X small percentage advantage over the market because we checked whether it's expensive or not. We checked whether it is quality, history, whatever we knew. We checked whether this industry is very competitive or not, whether it is working capital intensive or not. And therefore, it gave us a very piddly advantage over the market. Now, if I play this game with 2 stocks, I could be wrong. I could buy a very cheap stock and everything else good, and it does not go up because there's a fire in their factory, or even otherwise. You play this with 30, 40 stocks and you play it year after year. And we can show you a performance. It has to work, because there is no 9th reason for getting a stock into the bottom half or the top half. If there is a 9th reason, we'll put it in. Bottom line is, these are the reasons, and if these are the reasons, you might as well try and control them before. And the controlling does not require you to know how good it is. It should not be bad is the first thing. And the bad requires one line. So let us say people say, oh, what is valuation which is reasonable? So we say very simply, if a company for the last 4-5 years or X number of years since we have owned it, or the market has owned it, or whatever, the earnings are growing X% per annum, but the stock price is growing X plus 10% per annum, 8% per annum. If we own it in the beginning, we will enjoy it. But later on, we know this is not sustainable. And so we will trim it, saying it is out of line. We want the returns to come for established companies from earnings rather than re-rating of earnings which were already well re-rated or well known, say in 2015, 14, 18, whatever. Means it was not a new company then. For its previous 20 years life, it should trade at say 30p. Why should it be trading at 100p today? So we don't like it. Now let us say that the company does well and therefore it goes up 20%. तो क्या हो गया? हमने वो पैसे, when we sold that stock, we didn't put it in a bank. We bought some other stock with it. Maybe that went up 15% or maybe it went up 25%. Who knows? It's a continuous game. But you broadly know that if it is a bad history, if it is bad governance, if it is from a very competitive industry, if it is from an industry, say like infra, where government is a large customer and doesn't pay on time, or it has very high valuation, or whatever else little bit you know, it has low chances of being in the first half, or it has more chance of being in the second half. We don't want ex ante a stock for which we say, yeah, this can easily make it come. But in the end, many of our stocks are also in the second half. In fact, our number one holding, HDFC Bank, has been in the second half for the last 3-4 years. So it's not that this is a magic thing, but when you're putting 30 odd bets on the table, the stats will work in your favor. Quickly, I'm not showing you these because here I'm not selling you my fund. I'll just show you this last one. How many stocks to own? So we say that there are two kinds of stocks because we want to do broadly well. We don't want, oh, this year mid caps are doing well, so I'm number one. Next year mid caps are doing badly, so I will hide till I wait for my mid caps to do well, and then suddenly financials are doing well. And then the fellow who says I have financials will be a hero, and then one day another guy will say only quality is good, and then for 6 months he'll be a hero. We want to basically be up there somewhere broadly every year because that is the way we thought of it. So the first group is stocks which we can now call them good. These are stocks where everybody knows they are good. These in today's context would be stocks like TCS or INFI or HDFC Bank or Bharti or whatever. Now here, everybody knows they are good. You are not some hero that only you know. So therefore returns cannot be high, but they can be consistent. So we call these high confidence in reasonable return. In these, the valuations over the last few years have not massively been re-rated. Little bit everything has been re-rated. You will broadly get decent returns, but you will not be embarrassed in bad times beyond a point. And so we hope that we can make 4-5% more than the market, which means the market will make, in general, not every year, but broadly over time, market makes 14% per annum in rupee terms. If you can make 17, 18 is very good. And then there is a second group where all our multi-baggers have come. There has been other than some chemical sector stocks, there has not been any multi-bagger I have not owned in the last 25 years in a decent run. But there, when those 8 factors are looked at, some factors are confusing. For example, let us say Bajaj Finance, which we bought in 2011, and it went up 70 times for us. At that time, you don't know management is good. So we say management is not bad, but the industry is good, the group is good, and valuations are very good, blah, blah, blah. But you don't know that everything is good. It's not like these companies which have now, because of just having done well for so long, can be called good if you want. So there we say not bad on some factors and good on some other factors. It should not be bad on any factor, but not bad means we can't really call it good if you are on day one. So, for example, we used to own 5% of Kotak Bank in 2003. Now, Kotak Bank, it actually became a bank in 3 or 4. And everybody knew that the banking license is coming or whatever. It was announced. But the point is, how would you say is a good management? He was a broker before. So we would say, I guess, that it is not bad on management, but it is good on industry structure, on this competition with government, blah, blah, blah. And anyway, financials is a growing industry. This guy has a good investment banking, this thing, but we don't know that whether he's a good banker. So those are the stocks. For example, in 2020, in COVID times, we bought Indian hotels. Now, Indian hotel, the industry is good and the survivability is good and not getting disrupted. But one of our factors is trigger. There is no trigger. You don't know whether there is a vaccine. We don't know whether, but we said, okay, even if it takes 4 or 5 years for everything to come back, since the stock has fallen to half, it had fallen from 145.50 to $80. So even if in 4 or 5 years it goes back to a price that was there 2 3 months ago, it's okay. But those stocks, those kind of stocks, we don't buy more than 2%, maximum 2.5%. This is what we call reasonable confidence in high return. And we hope that if they work over time, they'll give you some, I don't know, 25% or whatever you want to call it. So it is this combo which has let me buy all the multi-baggers. But I can tell you, not one, maybe other than Z once in my life in the 90s, have I ever believed that the stock is even tripling. It is just, it does well and you hold it, and it does well and you hold it. And then if it goes out of line, or sometimes it becomes into the first group. But broadly to say, oh, I found a 20-year story, oh, please. The management has no idea itself that they are such big heroes. They turn out to be heroes because of a confluence of factors, and that is how life is. So as I said, the horizon for us is 1 to 3 years, and then you hold it in multiple. Nobody's telling you to sell it. But if you have to justify a 8-year, 10-year story, you already know that it is too complicated a stock, and that is why this justification is being given. So let's take questions now. How do I get this out of the way? Or you have to take it out, Kamal. Can't hear you. Okay, good.
So it has been very interesting and educative session, and reminds all of us of the old lessons in the new markets. So I have read, almost all the questions, and I think they pertain to now the way forward. So what are the new markets that you see? The very first question I will just articulate that now post correction, some of these high valued businesses like Avenue Supermart, Dixon Technologies, right, which have fallen from maybe 20% to 50-60%. And the average P of top 100 companies in India, I think, still is above 60. If one, tries to
60.
I think average P will be around above 55, 60. So
for which group?
Top 100 companies in India.
No, will not be.
Okay.
Will not. But anyway, so the question is, for these very high valuation companies,
right,
what should be done?
Correct.
According to me, because in our other fund we are short also many of these companies, the big picture is that if you look at the US market, or you look at Indian market, or you look at these new IPOs, or you look at private equity funding, everything is going back to 3, 4, 5 years. Now, let us say there's a company which I won't give the name, but let's say it has oil or oil-related things as its input. Now, these companies in 2014, when oil was $100, were trading at 40 to 45 times current year's multiple. It's the easiest to just look at current year, which means you look at March 31 price, and March 31 of that year EPS, which you may not have known that day, but doesn't matter. You knew it 2 months later that exactly what happened for that year. Anyway, you knew 9 months result. So some of these companies were trading at 40 and 45 times that live price, live earnings. On what basis should these be companies trading at 100, that same factor today 100? So the reason can be that, at that time oil was 100, and then the price of oil and oil related and other commodities fell, and you were a consumer company, so you increased prices by 2% and 4%, and everybody said, what great guys you are, that you are only increasing prices by a small percentage because you are able to show higher margin to the investor. That is because your commodity input was falling, and therefore you could get away with a 2 and 3 and 4% this thing and be seen as a consistent fellow. Now suddenly oil is more than 100, and every day the question to you is, hello, when are you going to catch up on the margin? Therefore, 8 years you were in total command of 7 years because the input prices were falling. So if at that time you were trading at 45 times current, whatever, maybe you should not trade at 45, but why should you trade at 100? So according to me, all these things have to go back from their highs, maybe 30, 40%, relatively speaking, or sometimes they may not go back because the market may go up and you may underperform. But you cannot escape this. You cannot just say that I will So let's say that every year for some of these companies, and the best way for you guys to look at it is just type screener.in and look at any company and see its 10-year earning growth, 10-year sales growth, 10-year share price growth. What the hell? And don't fall for this, it's cash flow. I mean, what nonsense is that? Because even if it is cash flow, then that cash flow, that means you were very poorly run in 2015 or 10 or whatever, that at that time you were not efficient. So that when you grew 10%, your bottom line, you could grow 20%. But going forward, unless you specifically know that this fellow is the most inefficient fellow you've ever come across, there is no reason that you can project for the next 5-10 years that the earnings growth will be X, but the bottom line will be X plus something. It doesn't happen because it is only converting of earnings to cash, which is called cash flow. It doesn't come from something else. Secondly, if the cash flow is good, it should have led for the earnings to be good because you had more cash, you could have bought new things, you could have put it in a bank account and earn, but we know that it didn't happen. So what I'm saying is, in a few minutes of underperformance, we cannot let our guards down. So there are two reasons or two things that are acting on a high price stock. One is that the valuation itself will be reduced because basically when you have high valuation, it means you are willing to play for a longer term period. And that is why I say, no, look, hold it for 10 years and things will be all right. So when those earnings which you are looking in 2030 and 35 are discounted at a higher rate, the price will fall. But secondly, what has happened is that most of these companies that have high valuation are also consumers of commodities. And the commodity price hike, which by the way, even today the prices were higher. So it's not that we are talking about last week. Even today oil price was higher, right? Actually just yesterday or today, these sanctions or whatever, these Europeans say we will not buy X amount of oil. So not only is reducing the demand of the end consumer, but for you it's an input at a high cost. So कैसे इतनी जल्दी आप बच के जाओगे? You have to give back the extra valuation.
So Samir, I have this question which was asked by one of the clients, and I really relate to that question. So on one side in this industry, we have fund managers like you who are very well educated, very well experienced, and I think they know too much. So you can analyze a company in terms of valuation, if it is high or low, from various aspects. And that may kind of restrain you from entering into it, or may give you confidence to enter into it based on your conviction and obviously based on your years of learning. On the other side, there are these other set of fund managers who are kind of trying to rotate between stocks and trying to generate alpha more aggressively and trying to participate in what is currently being driven in terms of today's fad or today's theme or today's style. But obviously there is a risk in that. So how should a investor look at all two types of these fund managers in terms of selecting what are the risks and rewards of going with A versus B?
No. This question, how can I answer? The client has to see whether the other guy, is he using some formal logic or is he looking at charts? So maybe somebody likes to buy based on charts. There'll be people who have done well in life.
I'll just give you an example. So you keep yourself as a fund manager on one side, and the other fund manager talks about investing into things like special situations, which Yeah.
So I don't think there's anything wrong with it. I mean, there could be a niche strategy. There's nothing wrong with saying special situation. But the thing, there is an analysis required is of a very different kind. The another thing why I, in the past, never overly did special situations or value unlocking, because in those days I used to believe that we don't have the regulatory structure, that you can't fight with a corporate to say do this or do that or sell off this asset, because the corporate who might be getting some private gains out of that does not want to listen to you. Nowadays those things have become a little better. But what is a special situation if you mean, for example, Piramal is splitting into two? I mean, these kind of things. So for us, anyway, big picture, because we buy 30 to 35 stocks, and because we think we are, my peer group from at least Wharton School, who have gone into fund management, some of them are managing US funds, global funds, Asian funds, right? Say, let's say emerging markets, or let's say from Alliance. Now, those guys who I in no way think are more intelligent than me are managing 20 countries and 30 countries के stocks and 20 currencies and 20 prime ministers and 20 whatever interest rates. हम गधे एक market में invest करते हैं, which is less than 1% of the world. So are we complete idiots to say कि इस मार्केट के अंदर भी ना हम ये नहीं करते, हम इसमें भी 15 कंपनियों में डालते हैं, हम इसमें भी 16, अरे पढ़े लिखे आदमी है वो कर रहा है, हम नहीं कर सकते. तो हम कहते हैं if a company is cheap and it can be justified on the fact that it is cheap, we can buy it at the same time when we are buying another company because it is growing fast and therefore has a higher valuation. By the way, valuation also is not absolute. For example, I am only objecting to companies that grow in line with our with our nominal GDP growth, 10-12%. But if you can grow 30-35% for a long time, maybe 5 years, जैसे बजाज फाइनेंस वगैरह करते हैं, then nothing wrong, because 30-35 की compounding भी solid होती है, तो उसका वो 2-3 साल में ठीक हो जाता है काम. बट अगर आप ग्रो कर रहे हो हमारी तरह, तो कहानी सुना रहे हो कि हमारा ये हो गया वो हो गया, दैट यू गॉन फ्रॉम 140 to 100, दैट इज द ऑब्जेक्शन. बट व्हाट आई एम ट्राइंग टू से इज, व्हाई शुड इट बी आइदर और? आई मीन, आर वी सो डम कि हम खाली एक चीज कर सकते हैं? अगर वो बंदा वो अलग से कर रहा है, हम उसको हायर क्यों नहीं कर सकते? हमारे भी तो बड़े सारे लोग हैं. सो देयरफॉर आई डोंट कंसीडर दिस बियॉन्ड अ पॉइंट, unless that fellow has, or somebody has some expertise or something, that particularly a PMS in which you are putting a rather high amount, unless you are a big family office. So for them to go into this narrow thing, once in a while somebody will be a hero there in terms of, having done well, and maybe he understands it. But these things should be all built into the same fund. Why should, what the deliberate strategy of our industry has been is to say, I buy only small cap stocks between 500 crore and 1120 crores. So now you as a investor have accepted my strategy. Well, I specifically told you what I do. अब in this, let's say there are 80 company universe. उसमें से मेरे को 1 मिनट में समझ आ गया कि 20 ही कंपनियां लेने लायक हैं और 60 नहीं है. ओके, आई एम एज अ फंड मैनेजर. तो फंड मैनेजर ने आपको बोला कि मैं ये 20 कंपनियां लूंगा. अब दैट फंड डज नॉट डू वेल, तो क्या बोलोगे आप क्लाइंट को? आप क्लाइंट को बोलोगे हमने तो आपको पहले ही बता दिया था हम ये करते हैं. हमने कोई ट्रांसपेरेंसी में कोई झूठ करा? हमने जो बोला था क्या वो नहीं किया? हमने वही किया जो हमने आपको बोला था. यू बॉट इनटू इट, मुझे 2.5% दे दो. नाउ लेट अस से द फंड डज वेल. ही विल से सी आई हैव गिवन यू सो मच वैल्यू. आई डोंट लाइक दैट. आई वांट कि आई हैव टू टेक दैट डिसीजन कि हम थोड़ा सा मिड कैप में डालें, कि थोड़ा सा लार्ज कैप में, कि थोड़ा सा सिक्लिकल में, कि थोड़ा सा ग्रोथ में. ये क्या मतलब है कि इतना नैरो कर दो उसके लिए? That see, I have not changed the mandate. Obviously, you have not changed the mandate. It was so narrow, so that I don't agree with it. Anyway, और पूछो.
So, what is your view on this merger which happened of HDFC and HDFC Bank? Stock went up in the beginning and then got rogered after that. And now
I need to like it. As I have said, we still own it. It's, I think, our first or second largest position. वो price pool से change हो जाता है. But I do like it. But again, the question is why do you like it and किससे compare हो रहा है? हमारा आपको अपने फर्स्ट ग्रुप बताया is high confidence in reasonable return. उसमें तो बिल्कुल फिट बैठता है. अब वो दिए नहीं उसने 2 सालों से, बट वो हर बारी एक्स एंटे लगता है कि ये बिल्कुल फिट है. So it is perfect for that. So the other way to look at it is कि जो लोगों ने बेचा है, other than some technical issue कि वो FI कोटा भाव देगा, उसका मुझे नहीं पता, because previously for 8 years from 2013 December it has not been in the index, and so when it was doing well we all enjoyed it because हमारे इंडेक्स में नहीं था, which is MSCI India, but हमारे पास था. Now for 3 years वो इंडेक्स में नहीं है, तो इंडेक्स को हर्ट नहीं कर रहा, बट लोगों को हर्ट कर रहा है, तो some of them have given up. But in a big picture sense, if the guys who are selling it are effectively saying, in my 20-30 stock portfolio, it does not deserve to be even the 30th stock. I disagree with that. I think मैं कहता हूँ कि यार मेरे 30th stock से better है कि नहीं है? It's definitely better. So ठीक है, फिर अभी चलते हैं, देखते हैं फायदा.
So given your so much in-depth understanding and focus on definitely valuations, which is important, as a fund manager, investment manager. Now, when you see valuations of some of these new age companies like Zomato, Nykaa, which have fallen almost 60-70%, do you still feel confident in adding them to your portfolio, or you have?
I don't have any of them. And अब ये सब चीजें पता नहीं, but actually Zomato मेरे पास है नहीं. But Zomato इतना बुरा नहीं था at this valuation, because their business is not easy to recreate, and there will always be only two. Okay. उनकी गलती हो गई 2-3, अब पता नहीं, अब क्या होता है कि वो मूड खराब हो जाता है, तो these things take time. But the 2-3 things that they did was, one is to say कि we are investing in other loss making companies. That, because I was willing to buy it at 75 when it was falling, but by मतलब जब मैंने पहले सोचा था, और even 80, but क्या हुआ कि they said कि we are investing in these other loss making companies, से सब upset हो गए. Second was कि हम तो बात नहीं करते किसी से, there will be no call, ये तो once a year call हुई है, और लोगों को गुस्सा चढ़ गया. फंड मैनेजर को आपको थोड़ा सा ईगो बूस्ट करनी पड़ेगी, हमारी भी, तब बंदे बैड टाइम में सपोर्ट करने आएंगे. आपको जी हमें नहीं करना, हम तो प्राइवेट इक्विटी फंडेड है, गो टू हेल. हम कहते हैं यू गो टू हेल, क्योंकि हमारे पास तो 150 कंपनियां हमारे फॉर्मूले से, हमने एक और छोड़ दी तो 149 में से ढूंढेंगे. इसलिए if you see my thing, I don't care fuck for anybody, because there are 148 other I can care about. So the point is वो रिलेशनशिप खराब कर दी मार्केट से. अगर ओरिजिनली अगर वो 75-80 पे आते या 60 होता है, 75 पे थे बेचारे, बट मतलब जैसे पेटीएम, अगर पेटीएम उस वक्त 500 में आता, क्यों ना लेते? सब लेते, मैं भी लेता, क्योंकि हम कहते हैं कि चलो जी प्रीवियस राउंड ऑफ वैल्यूएशन इतने पे हुई है. वो क्या हुआ, उन्होंने ऐसे सबने कर दिया. अब जैसे एक नए वाले ने किया, क्या नाम ले उसका, वो ब्लडी 6 महीने पहले यू आर ट्रेडिंग एट 23,000 करोड़ में आप रेस कर रहे हो. द होल वर्ल्ड मार्केट कैप इज डाउन 50-60-80%, एंड आर मार्केट के हमारे दिग्गज लोगों ने उसके ऊपर 50% वैल्यूएशन पे दे दिया. ये जो भी लास्ट आईपीओ है, अब ये सब हमारे ऑड्स में नहीं बैठता कि भाई ऑड्स आर नॉट इन फेवर ऑफ दिस 10-year व्यू इन पब्लिक मार्केट की 10 साल में ये बिगेस्ट कंपनी बन जाएगी, लॉजिस्टिक्स कंपनी बन जाएगी, ये बन जाएगी. सो बट एक्चुअली आउट ऑफ ऑल ऑफ दीज आई लाइक Zomato. वी डोंट ओन इट, but I think Zomato is better than all of these, except that they little bit shot themselves in the foot.
The fear which is going on, around inflation and liquidity reduction by Fed, and the stance which has become, hawkish from bullish, right? What are your views, and what do you see?
I've been saying it from January that you cannot have it both ways. You cannot say for the last 2 years कि जी easy liquidity से बड़े पैसे बने, और आपको we don't. I mean, how can you come, or how can you say to yourself? That's why I say don't fool yourself. Forget about fooling others. How can you say I don't look at inflation? You can say that when inflation is not an issue. You may say that inflation is not an issue, so who the hell am I to predict inflation, because वो तो complicated है. It's like saying अगर आप जनवरी में मुझसे पूछते कि यूक्रेन वॉर के बारे में आपका क्या व्यू है, मैं कहता जी ये सब हमारे बस के बाहर है. मोस्टली दीज थिंग्स डोंट वर्क आउट. मोस्टली मतलब wars don't happen. It is a low probability impact. It is low probability high impact event. बट कहाँ, तो हम तो जनवरी एंड में भी चलो इस पॉइंट पे कहते हैं हमें नहीं पता, लेकिन हम कुछ नहीं कर रहे. अब वॉर शुरू हो जाए, ओके जी वॉर नहीं, अभी डोंट लुक एट वॉर्स. What do you mean you don't look at war? अब वॉर शुरू हो गई है. It's the same thing with inflation. You are in the middle of the biggest fight ever, or at least in the last 30-40 years, of the US Fed, where there was one more lesson which I did not give, which is don't fight the Fed. So the reason why still we are all hopeful is कि maybe Fed in 2-3-4 months will feel कि inflation is trending down aggressive. इसलिए फ्राइडे को बड़ी थी because वो पीसी नंबर below 5% आ गया, तो वो भी अभी guess work चल रहा है. बिल्कुल ओके, I also agree, हमने भी थोड़ा बहुत ले लिया. But point is you cannot say कि it's done and dusted and is discounted, because nothing in the world is discounted till it happens. कौन सी चीज डिस्काउंट हुई है आज तक? कुछ नहीं हुई.
When you buy a stock, you have some framework, you have some conviction, and when you continue to hold that stock, does that framework or conviction remain the same, or there has to be a different thought process in holding a stock versus buying a stock?
So the thing is, हमारे हिसाब से conviction आती है जब आप right प्रूव हो जाओ. इसलिए ये जो एक क्वेश्चन है, विच इज वन ऑफ द मोस्ट रिडिकुलस क्वेश्चन, प्लीज सॉरी, बिकॉज आई हैव सीन इट ऑल माई लाइफ, इज द बुलशिट स्टोरी, कि अगर आपको पता है कि ये स्टॉक बढ़ रहा है, 100 बैगर हो रहा है, बाय द वे आई हैव हैड एटलीस्ट 4-500 बैगर्स, माय होल एनएवी प्री परफॉर्मेंस फीस अप सम 350 टाइम्स इन 25 इयर्स, तो बड़े सारे मल्टी बैगर आए हैं, किसी को नहीं पता होता कि ये 100 बैगर बनने के इसके प्लान है। तो जो लोग कहते हैं कि if it is a multi bagger, how will your life change if you bought only 2%? हम तो 1.5 से भी शुरू करते हैं, ओके, इन दोस 20 स्टॉक्स। सो द थिंग इज कि अगर वो स्टॉक में 100 बैगर बनना है तो पहले उसको 2 बैगर बनना है। सो जब वो 2 बैगर बन गया तो मेरा 2 का 4 हो गया ना, तो अब आज से 50 टाइम और जा सकते हैं ना। तो अगर इफ यू नो कि 50 टाइम पता फिर भी नहीं होता, द पॉइंट इज यू आर पुटिंग 10-15 बेट्स, उसमें 1-2 इतने बड़े चलेंगे अगर चले भी तो। So this story that you know. Second thing is, if your hurdle was very high, which means you say I only buy 10% in a stock or nothing, because you are wanting to have high impact on your portfolio. So you are basically saying या तो मैं 8-10% लूंगा, नहीं तो नहीं लूंगा, obviously, because अगर 2% लोगे तो हमारे जैसे बन जाओगे। तो आप कितने दिन वेट करोगे उस स्टॉक को लेने के लिए? क्योंकि आप जिस दिन हम 2% के लिए कन्विंस्ड होते हैं, आप 10% के लिए कन्विंस नहीं हो सकते थ्योरेटिकली। ऐसा क्या आपने देख लिया जो है हम 2 पे डर डर के ले रहे हो, आपको नहीं 10 है, दैट इज अ ब्लाइंड खेल रहे हो, विच वंस इन अ वाइल में वर्क बट ब्रॉडली विल नॉट वर्क। सो द थिंग इज, आपने अगर 2% लिया एंड द स्टॉक गोज अप 10% और 20%, तो हमारा स्टॉक बढ़ा है ना, अब हम उसको और ले सकते हैं 1%, लेकिन आप नहीं ले पाओगे क्योंकि आप कहोगे यार मैं आई वाज वेटिंग फॉर फर्दर कन्विक्शन, वो मैंने 100 में देखा था 120 हो गया, मैं कैसे लूं? या अगर बहुत चल गया तो 100 का 100, मैं तो 100 से देख रहा था, आई वाज वेटिंग फॉर दिस रिजल्ट, आई वाज वेटिंग फॉर दैट। हम कहते हैं ऑड्स, 8 फैक्टरों पे ऑड्स खेल रहे हैं। वंस इन अ वाइल पिटते हैं, 10-20-30% जाते हैं, जाओ। So this 2% business is only if you already know that the stock is doing well, which nobody knows.
So what are the top 3, sectors that you want to bet on in next 2 years?
We don't change our sectors, that I've already said so many times. These are always financials, consumer and tech. And आजकल उसको टेक फार्मा बनाया हुआ है, टेक फार्मा स्पेशलिटी केमिकल। उसमें जो सेकंड ग्रुप है कंज्यूमर का, उसमें अब हमने नई थ्योरी बनाई है कि हमें चाहिए, थ्योरी मींस पैकेजिंग ऑफ द सेम स्टॉक्स, कि हाउ टू फ्रेम इट इज दैट वी वांट स्टॉक्स व्हिच आर केटरिंग टू द से द 30-40 मिलियन टू द 300 मिलियन, मतलब मिडिल क्लास कंज्यूमर के लिए सस्ती चीजें जो बनाएगा वो वाले स्टॉक चाहिए। लेकिन उसकी अगर पी बड़ी हाई नहीं है, अगर हाई है जैसे 50 में भी होती है कईयों की, तो फिर कम से कम 30%, 25%, 2-3 साल तो ग्रो करो, उसके बाद फिर खुश के आपने भी 15 ही ग्रो करना है, बट 15% के लिए 60-70 नहीं देंगे। बट दैट सेक्टर इज अदरवाइज मोर expensive and more difficult to this, so you have to say कि हम इसको ऐसे देख रहे हैं, वैसे देख रहे हैं। It's just that we are not buying the egregious 100p type stocks which grow at 12%, and which have commodity issues. So right now we think we don't have very many, बस सबको कुछ ना कुछ कमोडिटी तो चाहिए, बट मोस्टली इट इज विजिबल वाली कमोडिटीज नहीं चाहिए।
So you wear both hats of a long only fund manager as well as a long short fund manager. Over next 5 years, if you are
long only fund manager is Mr. Dinshaw Rani.
Okay, right.
But same team.
Sure. So if you were to kind of put hand on your heart and suggest to a client that should a long aggressive equity oriented long short fund will give a better returns in gross terms, or well diversified long only equity fund?
So first of all, I don't know what is diversified. वो कई लोग हम 30-32 स्टॉक होते हैं हमारे पास, कई लोग उसको concentrated बोल देते हैं, वो तो ऐसी जो मर्जी बोल दो। So I have done long short for 17 years, और हमारा ऑब्जेक्टिव रहा है कि हम लॉन्ग शॉर्ट फंड में वी हैव टू बीट द लॉन्ग ओनली गाइज एंड आफ्टर चार्जिंग अ परफॉर्मेंस फी। कई लोग कहते हैं कि लॉन्ग शॉर्ट फंड में अगर जैसे 60 नेट है तो मोटा माटी ये यूएस वाले करते हैं, दे विल कंपेयर देमसेल्व्स विद द हेज फंड इंडेक्स, which is all the losers of life, because they will never outperform the index, but they will say to the client कि हम तो hedged है जी, तो इसलिए बैड मार्केट में हमने आपको बड़ा बचाया था और गुड मार्केट में कम किया, बट बिकॉज गुड मार्केट्स आर मोर देन बैड मार्केट्स, सो इसलिए नॉर्मली मार्केट्स गो अप। तो उसमें for an Indian guy in a big picture long term sense, there is no need to do long short. Long short is done by an institutional guy जो कहते हैं मेरे को बैड ईयर में कम बैड करना। हम कहते हैं हम जीरो नहीं करेंगे, क्योंकि जो आदमी बैड पीरियड में जीरो करता है वो गुड पीरियड में 50-60 नहीं पड़ता। हम तो गुड पीरियड में, जैसे लास्ट ईयर मार्केट इज अप सम 20%, हम 60 नेट है, वी आर सम 32% इन डॉलर, और कई सालों में हम 70% अप है, इवन दो वी आर लॉन्ग शॉर्ट, बिकॉज वी आर नॉट ट्राइंग टू बी दैट काइंड ऑफ अ लॉन्ग शॉर्ट। लेकिन मार्केट अगर 20 गिरेगी, ये नहीं कि हम गिरेंगे नहीं, हम भी 10 गिरेंगे, 12 भी गिरेंगे, बट 20 नहीं गिरेंगे। बट दैट फॉलिंग ऑफ दैट, if somebody else is fallen 20 and you fall 10-12, उसकी कंपाउंडिंग इतनी बढ़िया हो जाती है ना कि next year he has to do much better to over time gain, because the money that you save, that value is very big, but it's all marketing in some sense। जो आदमी नर्वस है उसको कहते हैं तो लॉन्ग शॉट ले ले भाई, बट तेरे को रिटर्न कोशिश करेंगे लॉन्ग ओनली वाले की, and so far we have done it, over nearly every period। But it is a much more strenuous work. I like long only, जो मिस्टर रानी का है, कोई काम नहीं है, 30 स्टॉक लिए, 2-4 एक आध बदला। यहाँ हमें हर वक्त कुछ शॉर्ट करना है, कुछ लॉन्ग करना है, कुछ ये करना है, कुछ वो करना है। दिन में 4 चीजें करता हूँ मैं, which I enjoy, but still it is different.
So does it, for a moderate investor, should one stick to investing in the universe of top 100 companies for making, say, 15% kind of return with consistency, or one should deep kind of take a risk?
So the way what we are doing is we are not investing in 100, but mota mati we are investing in top 300, but उन 300 में 20-22 हमारी भी top 100 वाली होंगी। See, 100th कंपनी का मार्केट कैप क्या होगा, 5-6 बिलियन होगा मेरे ख्याल से, because the 400th company has $1 billion market cap. So 5-6 बिलियन इज अ बिट रिस्ट्रिक्टिव। काफी सारी कंपनियां स्वीट स्पॉट होता है कि अगर आप 1-1.5-2 बिलियन मार्केट कैप तक पहुंच गए हो, दैट मींस आपने अपनी लाइफ का मुश्किल पीरियड, व्हिच इज टू ग्रो टू अ सर्टेन लाइक बिलियनियर टाइप स्टेटस, इज टफ। तो उसके बाद इन थियोरी दे शुड डू मच बेटर। एक्चुअली दिस 100-200 मिलियन वाली हो सकता है अटक जाए, बट व्हेन यू रीच $1 billion, $2 billion, एक्चुअली दैट इज अ गुड स्पॉट टू बाय। So I would not say कि top 100 में करो।
So if the average market cap
to $1.5 billion, $2 billion starting market cap, if you are, so that I think would take you, my guess, पता नहीं, maybe 250 तक जाएगा। It won't end at 100. 100 is really large. Like there'll be 10 billion, I think, my guess, or 12 billion.
So if the average market cap of the portfolio of say top 30 companies, in your case, say is 2.5 lakh crores, let's assume।
मेरे को $1 billion में बताओ, 2.5 30 billion.
Correct.
Okay.
Correct. Right.
Okay. पता नहीं मुझे, हो सकता है।
Can this beat a portfolio, which is say 15 billion as average market cap? Both are equally, quality fund managers. Over 5 years.
See, the thing is, in the end, out of these 35 companies, हमें 3-4 कंपनियां चाहिए जो 50-60% बढ़ जाए, forget about anything else। वो आपको 3-4% मिल गए। आप आउट परफॉर्म कितना करते हो मार्केट में? 6-7%। आपको है कि एक किसी में ज्यादा लॉस ना हो, 3-4-5 चल जाए, वो मोस्ट मोटामोटी चल जाती है। पर आई डोंट डू दिस। जब 30 बिलियन है कि 15 बिलियन है, ये बड़ा मुश्किल है। आई हैव नो आइडिया अनलेस आई रन माय पोर्टफोलियो एंड सी कहां से आया। बट ब्रॉडली इतनी ओवर एनालिसिस करना, इसी जो आदमी इतनी ओवर एनालिसिस कर रहा है ना, ही इज स्पिनिंग अ स्टोरी। एंड I don't mind people saying I like small caps, and I don't mind people saying I like large caps, and I don't mind people I like cyclical, but I don't like stories, because stories are, according to me, a lie to sell. So I don't like lies. That is just the way it is. So I don't know. But जो इतना precise कर रहा है ना कि मैं इतने से इतने लेता हूँ, इतने से इतने लेता हूँ, he's telling a story because he wants to fit into a universe. एंड से कि ये देखिए, अगर मैंने ना 16 से 20 वाले लेते हैं ना, जो उनके इतने पैसे बन जाते हैं, बनते नहीं है, बने थे। वो आपने डेटा वो करके चर्न करके आपने निकाल लिया कहो जी ये मेरी स्ट्रेटजी, ऐसी होती नहीं ना स्ट्रेटजी। प्रैक्टिकल स्ट्रेटजी होती है कि हम ब्रॉडली अच्छी कंपनियां लेते हैं, हमें ब्रॉडली हाई आरओआई चाहिए, हमें ब्रॉडली ये चाहिए, बट ये मत बोलो कि अब 5 साल का ट्रैक रिकॉर्ड देखते हैं, क्योंकि 4.25 साल बाद क्या करोगे, अब वेट करते रहोगे उसकी 9 महीने अगर वो अच्छा कर रहा है, या कोई जी 15% आरओआई लेते हो 14.7 है, कहोगे नहीं जी हम तो देखते नहीं है, पहले तू 15 करके आ। दिस इज अ वे ऑफ जस्ट artificially trying to create a story. That's what I mean.
So there is this question which is asked by Mr. Chaitanya, which says, "What are your thoughts on 80% returns come from 20% of stocks?"
Of course not, यार. अभी तो आपको दिखा दिया कि हो ही नहीं सकता. It's a way of different way of saying it. So let us say I ask you a question that over the last 50 years, how many companies in the US have created wealth? You will say maybe 2, 5, because 50 साल की कंपनियां नहीं हुई, तो आप कहोगे फिलिप मॉरिस, अब जी वगैरह बंद हो गई तो क्या बोलोगे। सो आगे से अगर आप 25 साल 50 साल देखो, एक्चुअली 4-5 कंपनियां रह जाएगी जो चलती है इतने साल, तो यू विल से कि 5 कंपनीज हैव क्रिएटेड वेल्थ। भाई आप 1 साल के, 2 साल के, 5 साल के देखो। Actually, I use that in one of my presentations that in the last 25 years, I forget, but some 200 companies are up more than 100 times. और वेल्थ क्यों नहीं क्रिएट हुई। और एक और बात सोचिए, अगर 15% ऑफ कंपनीज इन इंडिया आर क्रिएटिंग वेल्थ, तो ये हमारे बेचारे 85% कंपनी है, उनके एम्प्लॉयज कर क्या रहे हैं, वो पीएमएस में पैसे कैसे डाल रहे हैं, वो उनके पास सारे चोर हैं। So basically we are saying that everybody who puts money in our fund, 95% of them are working for chores, inefficient, money guzzlers, but they have money that they can give us. But otherwise they are very inefficient or mostly corrupt and don't pay their taxes and will basically die. But हमारे को पैसे invest करने के लिए दे देते हैं, ऐसे कैसे हो सकता है यार? So the point is, if you make the horizon 3 to 5 years, first of all, let's see there. I presented there 4 companies. Havens, who would have known 28%? मैं तो randomly choose किया था. I was just trying to see कौन से मेरे दिमाग में आ रहे थे कि high return किन किन के बने हैं लास्ट 10 सालों में। 4 कंपनियां तो यही थी जो 25-30% पर एनम चल रही है, तो रैंडमली चूज की गई है। तो इन 4 में से 2 तो आप गिनते ही नहीं हो किसी लिस्ट में कि 15 कंपनियां क्रिएट वेल्थ किया है, तो नहीं ऐसे थोड़ा होता है, ऐसे वर्ल्ड चलता है क्या? ये हमारी 100 कंपनियां, ऑफ कोर्स आई बिलीव दैट, बट 100 कंपनीज आर यूनिकॉर्न। उनके प्रोमोटर से पूछो जिन्होंने अपने 100 मिलियन के शेयर बेच दिए कि तुम्हारी वेल्थ नहीं क्रिएट हुई। अरे मुकेश अंबानी जी से पूछो, उनकी वेल्थ नहीं क्रिएट हुई बिकॉज उनका फ्री कैश फ्लो नहीं था। ही इज द रिचेस्ट मैन ऑफ इंडिया से बोलो नो सॉरी यू हैव नॉट क्रिएटेड। ऐसे थोड़ा वर्ल्ड चलती है। द थिंग इज एवरी स्टॉक शुड नॉट बी ऑफ वन स्टाइल, दैट इज माई थिंग। कभी आप कहोगे कि इसमें एक्चुअल फ्री कैश फ्लो है, इसमें बोलोगे इसमें वेरी हाई ग्रोथ है, इसमें बोलोगे इसमें ये बड़ा बढ़िया है, इसमें बोलोगे बड़ा सस्ता है। अपने आप वो मिक्स एंड मैच करके चीजें चलेंगी, हर चीज नहीं चलेगी। बट द आंसर टू हर चीज नहीं चलेगी इज नॉट कि एक चीज ही करो बिकॉज वही चलेगा, क्योंकि वो भी 2-3 साल ही चलेगा। सो द कंसिस्टेंसी इन टर्म्स ऑफ सर्वाइवल एंड ब्रॉडली डूइंग वेल इज नॉट टू बी कॉट इन दीज लाइन्स, बिकॉज कोई भी फॉर्मूला पूरा नहीं चलेगा। आप हमारे बिगेस्ट म्यूचुअल फंड मैनेजर को देख लो, इतना बढ़िया करता था, फिर 6-7 साल का वेरी नैरो व्यू ले लिया कि मेरे को खाली लो मतलब वैल्यू स्टॉक्स चाहिए, फिर 4-5 साल नहीं चला, फिर 1 साल चल गया, अब 1 साल चल गया तो डज इट मेक अप फॉर द 6 ईयर जो नहीं चला? आई डोंट थिंक सो। पर हर आदमी का थोड़ा थोड़ा नंबर आएगा, बट यू कैन वेट फॉर दैट कि आई ओनली बाय दिस बिकॉज 7-8 साल में मेरा नंबर भी आ जाएगा।
Right. What is your view on the QSR industry?
We like.
Okay.
Because QSR also feeds into our middle class, under-penetrated. We like middle class and the consumers and affordable things mostly. Yeah, यही सब चीजें होती हैं। And also अभी तो उसका एक और फायदा ये हो गया कि in theory, at least the one we own McDonald's, कि वो ओपनिंग अप ट्रेड है, आप मॉल में जाओगे, आप impulse buying करोगे, and दूसरा भी ठीक ही है उनका, which is this home delivery, and then they have coffee. All these things matter because आप उसी स्टोर में कुछ और ठोक दो, कोई कॉफी भी ठोक दो, साथ में को ब्रेकफास्ट भी खा ले भाई, रेंट वही है, आपका फर्नीचर वही है, 4 बंदे सुबह रखे, कुछ और बना दिया, and then overall back to work in this case, in the sense back to going out and all that.
Many portfolio managers have of late increased their weights in the real estate oriented businesses.
We also
feed into real estate, financing businesses, real estate. What's your view in this regards?
We agree with that because real estate में क्या हुआ कि 8-10 साल तक प्राइसेस भी बढ़ी, एंड उस दौरान में जो भी कहें, 2 wealth creating groups became big. One is the tech guys, one is the startup guys. Because if you see in aggregate की wealth new creation का हुई है, you need some new pools of money. तीसरा थोड़ा सा स्टॉक मार्केट वालों का भी हो गया 2-3 साल, एंड फिर एक और हो गया योर ओन this thing that I don't want to live in a smaller place or I'm going to my own bigger place at home and all that, so थोड़ा spread हो गया. So far so good है, but अब इंटरेस्ट रेट फिर हाइक होंगे हमारे भी, एंड ये अपना एक पूल भी थोड़ा खत्म हो रहा है, which is this startup pool. But hopefully they find jobs in the other side, which is IT side, which helps our IT guys कि भाई inflation थोड़ी कम होगी. But I think the worst pool will be the startup pool in terms of from here on. Every day you see anyway firing going on and all that.
Now the $1 million question: what is your view on markets over next 2 years?
Who knows? But all I can tell you is, if I show you 25-year returns of the market, it is around 13.9 की 14% per annum. Okay, calendar year मैंने किया. उसमें अगर आपको चलो जी एवरेज 14% था, so let us look at 12 to 16 कि भाई एवरेज के 2% इधर, एवरेज के 2%, एक भी साल नहीं था 25 years में. आपको चलो और वाइडन करते हैं, 10 to 18 करते हैं, वो भी 2-3 साल थे, या तो -20 या +40, ये होती है लाइफ हमारी. लेकिन अगर आप हमसे किसी भी टाइम पे पूछते हैं तो हम कहते हैं जी आप पे 14-15% बन जाएंगे, बिकॉज वो बन जाते हैं, बिकॉज दैट इज द नॉमिनल ग्रोथ रेट ऑफ इंडिया, विच इज GDP प्लस सम रूपी कन्वर्जन कर लो, इन्फ्लेशन प्लस आपको जी 1-2% एक्स्ट्रा फॉर कॉर्पोरेट सेक्टर और फॉर सर्विसेज एंड मैन्युफैक्चरिंग रिलेटिव टू एग्रीकल्चर, ब्ला ब्ला ब्ला. बट वेदर प्रिसाइसली अभी बनेंगे कि बाद में बनेंगे, दैट इज द टफेस्ट थिंग. सो यू लिव डे टू डे एंड देन यू explain if it doesn't happen कि you will make it next year and you average, and एंड में बना देते हैं लोग, बन भी जाते हैं, it's not कि हम बना देते हैं, लोग भी बन जाते हैं. There is one question which I would like to answer because this question I feel is a good question कि how to sell a well performing stock. वो मैंने बड़े बेचे हैं, including all these big ones. So as I said, for the first group where we say going in that the company is well known already or was well known in our case से हमने 5 साल पहले डाला, तो उसमें हमें अर्निंग्स ग्रोथ चाहिए. अब उसमें कई बार उसकी भी री रेटिंग हो रही है, तो हमें कोई ऑब्जेक्शन होना है, हमारे पास अगर स्टॉक है, सो वी हैव इट, बट स्लोली वी विल ट्रिम इट and one day we will get out of it, independent of the fact that it is still doing well, but we'll drag it also. And I can tell you, in 99% of the cases, that stock will not do well if you do it like that. So, for example, we sold D-Mart in May of 2020 when there was a lockdown. They were not beneficiaries of the lockdown. The economy was closed and Reliance had got funded. And in 2020 till May, the stock was up 30%. अब किस बात के लिए? अगर आपने beginning of the year में हमने उसको, मतलब हमारा पुराना पड़ा था, लेकिन हमने अगर कोई हमें बोलता कि सब बढ़िया चलेगा, तो आप 30% रिटर्न से खुश नहीं होते इन अ स्टॉक व्हिच इज ऑलरेडी वेल नोन ऑन December 31, 2019. तो वो हमने बेच दिया. अब वो बीच में स्टॉक 6000 चला गया, बट जब वो 6000 गया, तभी भी अगर आप मई 2020 से उसकी मार्केट का रिटर्न देखते, उसे प्लस माइनस सेम था, पर हम खुश थे कि हमने ओवर वो नहीं किया, अब तो 20% रह गया हमारा, एनएवी सबकी 70% क्यूमुलेटिवली अप है जो भी है. सो द पॉइंट इज वंस इन अ वाइल इट विल हैपन कि दैट स्टॉक एक्चुअली आउट परफॉर्म्स द मार्केट. तो फिर क्या हो गया? तो क्या हो गया फिर? हमने कोई ये नहीं, हमारे कोई कहे जी वो तो स्टॉक 70% बढ़ गया, तो मैंने थोड़ा पैसे बैंक में बंद कर दिया कि मेरा रिटर्न 0 है. मैंने कुछ और खरीदा, उसमें मे भी 50 बन गए होंगे, बट कई बार उसमें 80 बन गए होंगे. बट मोस्टली you cannot live your life in a well-known name by making money from re-rating of an already well-known name. If it is a genuinely new stock and genuinely growing, as I said, at 30-40%, आप कह सकते हो भी वैल्यूएशन चलने दो, देखते हैं कहां तक जाती है. बट वो होते ही नहीं स्टॉक, वो 4 स्टॉक मिल रहे हैं जिंदगी में आपको ऐसे. हम तो डे टू डे लाइफ की बात कर रहे हैं.
With regards to economy, what are the 3 factors in favor of India currently that you see which will help India to actually become more than 5 trillion over the next 5-7 years?
First of all, one day it has to become 5 trillion. It is called compounding. आप 6-7% भी करो, करते जाओ, किसी साल तो 5 ट्रिलियन हो जाएगी. सो दैट इज इमटेरियल. इट्स लाइक हमारे एक ब्रोकर फ्रेंड कहते हैं जी बीएससी 2 लाख हो जाएगा. मैं क्यों 10 लाख क्यों नहीं होगा? आपने 15% पे कंपाउंड करते जाओ, किसी दिन तो होगा ही. सो एनीवे, सो द बिगेस्ट आई थिंक फ्रॉम अ रिलेटिव पॉइंट ऑफ व्यू इज दैट पीपल बोथ मतलब क्या कहते हैं एफडीआई टाइप्स या जो क्या कह सकते हैं कंपनीज, मतलब नॉट इन्वेस्टर्स बट ऑल्सो इन्वेस्टर्स, both will have a slight bias toward India relative to China going forward, simply because they have seen that putting all your eggs in one basket उन्हीं को नुकसान होता है. क्योंकि आप वहां पे बैठे हो, गैप में बैठे हो या जो भी आपकी दुकान है वहां बैठे हो, वो वहां पे किसी ने कोविड हो गया, किसी को कुछ हो गया, आपकी सप्लाई रुक गई. एंड प्लस इंडिया ने भी अपनी तरफ से 2-3 चीजें अच्छी करी, नॉट इन टर्म्स ऑफ टेक्सटाइल बट अदर थिंग, कि आपने वो प्रोटेक्शन लगा दी, मेक इन इंडिया लगा दिया, ड्यूटी लगा दी, वो पीएलआई कर दिया, ये वो कर दिया. तो वैसे भी उसको इंडिया में इंडिया के लिए बनाने के लिए बेटर है क्या? मतलब उसको ऑब्जेक्शन क्या है? टू एटलीस्ट फॉर इंडिया, मेक इट इन इंडिया. एंड इफ यू मेक इट इन इंडिया फॉर इंडिया इन इंडिया, आफ्टर सम टाइम उसको भी एक्सपोर्ट कर दो भाई, आप सेकेंड थर्ड सोर्स बना लो. सो दिस आई थिंक इज एक्चुअली वर्किंग. ये वाले में मैं कन्विंस्ड हूँ कि दे कैन बी अ चेंज. एंड द सेकंड फ्रॉम अ हमारे टाइप के, मतलब मैं तो इंडिया हूँ बट जो एशिया या इमर्जिंग मार्केट करते हैं उनको भी इतना क्या हो गया कि हमारे यहाँ 11-12% और उनके यहाँ 35%. सो मेरी थ्योरी उसमें ये है कि लेट अस से देयर आर 2 टेक कंपनीज, से इन्फोसिस, टीसीएस. अगर इन्फोसिस का रिजल्ट खराब आ जाए, आप 30 सेकेंड्स में नहीं कहते हो जल्दी से इन्फोसिस बेचो और टीसीएस खरीद लो. आप कहते हो भैया ठहर जा, दोनों ही बेच दो, या मे बी टीसीएस पहले बेचो क्योंकि वो कल डिसअपॉइंट करेगा. ये तो गिर चुका है 5% इफ इट इज सपोज disappointed. So it's the same thing with us. You are doing bloody fucking bleeding in China. Your end investor is also asking for money, or you yourself are, because you have a ability to go outside, whatever. आप दोनों से निकालोगे. अब वो 4-6 महीने बाद वी आर होपिंग कि वो थोड़े आप सोचोगे कि क्या करा मैंने या अब मैं क्या करूं. So right now you are associated with all these bad countries because you are part of that bucket, which is emerging market bucket or Asian bucket, God knows कौन सी bucket, or just bucket, everybody's financial. तो वो तो होना ही है. 2008 में मेरी गलती क्या थी जो मैं देखता हूँ कि सारे बच्चे कर रहे हैं, इसकी जो भी चीज वर्ल्ड में हुई है ना उसका सबसे पहले मैं ही बेनिफिशियरी हूँ. मेरी कंट्री सबसे पहली बेनिफिशियरी है. अच्छा जी वहाँ लीमन ब्रदर्स बंद हो गया, हाँ हाँ बड़ी खुशी, हमारे आईसीआईसीआई बैंक के पास तो कोई लीमन ब्रदर्स का है नहीं. कुछ वहाँ पे फाइनेंशियल सेक्टर को एक्सपोजर, उसको इक्विटी रेज करनी है, हाँ हाँ एचडीएफसी बैंक में तो इक्विटी पहले से ही बहुत है. और सबसे ज्यादा शेयर कौन सा बिका? एचडीएफसी बैंक, डाउन 52%, because we realized that we are all associated, we are all connected by the fact that we are all financial market this thing. So now I don't say all this nonsense कि यूक्रेन में लड़ाई होगी इंडिया को फायदा हो गया, रशिया में हो गया मेरे को फायदा हो गया. कुछ फायदा नहीं होगा शायद, बट उसको अभी सेलिब्रेट नहीं कर रहे हैं 1 मिनट. अभी you are connected by another problem, which is that you are all investments, you are all financial markets, you are all stocks. You mean you are portfolios. So we have to handle this period.
Right. So before we end this session, this is the last question to you, Samir. That now, putting yourself in the investor's shoe, over next 6 months, if one has to build one's portfolio, one should follow a cautious, staggered approach, at current levels, or one can kind of, go aggressively and do lump sum investment. So
no, absolutely not lump sum. Why lump sum? अभी तो मतलब कोई मतलब ही नहीं है लम्प सम. हमने अपने फंड में पूरे पैसे नहीं डाले. हमारे कुछ 11-12%. पहले तो हमने 16-17% कैश हो गया था जो हमने रेज किया था. मतलब ये नहीं कि कैश पड़ा हुआ था. पड़ा थोड़ा कुछ होता है. No, there is no lump sum requirement. And first of all, first thing, please understand that what you do depends on what you have done. What you see depends on what you have seen. So अगर आप कोई कहेगी लंप सम तो वो बोले जी मैं पहली बार जिंदगी में डाल रहा हूँ. हम कहते हैं तू 0 है जबकि तुझे होना चाहिए था 50% और अभी भी तू 20% को लंप सम बोल रहा है. डाल दे भाई. But we are talking about guys who are generally invested and उनके बाकी भी इन्वेस्टमेंट चल रही है, सेविंग चल रही है और अब आप जो और थोड़े पैसे आ गए. शांति से क्या हो गया? कहाँ जा रहा है? कुछ नहीं होगा. There is no pleasure because you will not get it कि हाय मैंने बॉटम पे खरीद लिया. आपका 80% तो चल ही रहा है ना. So I would say peacefully 2-3-4 months. Let's see how far US goes. अब क्या था कल फ्राइडे को we also were excited कि चलो US के नंबर ठीक हो गए. आज फिर वो उनका जो ये जो फेडरल रिजर्व के गवर्नर होते हैं कि क्या होते हैं प्रेसिडेंट, वो फिर आगे बोल गया नहीं जी अभी कहाँ जा रहे हो, अभी तो और इंटरेस्ट रेट बढ़ाने हैं बड़े सारे. There is no rush. But it's okay. But it's not some, oh, today is the day.
Thank you so much. I mean, we have, I think, spent 1 hour 45 minutes.
No, very good. I enjoy all these things because I like giving lectures to the world. I could have been a professor in some other life, but this is better.
Right.
Okay, thank you very much.
Thank you everyone for logging in.
Thank you, everybody. Bye-bye.